All right, let's talk about something that so many Canadian business owners know all too well, that financial roller coaster of running a seasonal business. You know, one minute you're absolutely flying high, and the next, you're just trying to hang on for dear life. But what if I told you there's a way to smooth out that ride? A way to turn those scary dips into real opportunities? Well, that's what we're getting into.
I mean, if you're in construction, tourism, agriculture, maybe landscaping, this probably looks painfully familiar, right? You've got those incredible high seasons where cash is flowing and everything's great. And then the off-season hits, and it's just quiet. That whole feast or famine thing, it can be absolutely brutal.
But here's the thing. That cycle, it does not have to control you. Look, the seasons are going to change. That's just a fact of life. But the financial stress that comes with it, that can be optional. Seriously. With the right strategy, you can be the one in the driver's seat.
So that's exactly what we're going to do in this explainer. We're going to break down a clear, step-by-step plan to help you not just survive the quiet months, but to actually use them to your advantage. We'll get into how to keep your cash flowing year-round and how to make those big, game-changing investments that are going to fuel your growth.
Okay, first things first. We need to understand how lenders look at businesses like yours. Their whole world revolves around stability, which, can feel a little tricky when your income chart looks like a mountain range. So they've got this special tool they use to measure your financial health.
It's called the Debt Service Coverage Ratio, or DSCR for short. Now, I know it sounds super technical, but it's actually really simple. It's just a lender's way of asking, hey, are you making enough cash to actually pay your bills? It's like a financial checkup. So let's say after your main expenses, your business brings in $150,000 in cash for the year. And all your debt payments, the truck, the tools, that line of credit, add up to $100,000. You just divide your cash by your debt. So 150 divided by 100,
And boom, that gives you 1.5. This number right here, this is the gold standard. A DSCR of 1.5 tells the lender that for every single dollar you owe in payments, you have $1.50 in cash flow to cover it. That's a really healthy cushion. It says you're a safe bet. But if that number dips below 1, that's a huge red flag for a lender. It basically means you aren't generating enough cash on your own to cover your debts. You're having to dip into savings or worse, borrow more just to make your payments. That, my friends, is the off-season cash crunch in a nutshell. And that's exactly what we're going to help you avoid.
So how do we stop that from happening? How do we keep that DSCR number looking good and healthy? Well, it all starts with mastering your cash flow. And I'm talking about small, simple changes that can make a massive difference, especially when business is slow. Because the more cash you can keep on hand, the better that ratio is going to look.
Just take a look at this. These are things you can do like today to get more cash in the bank. Get your customers paying you faster. You could even offer a tiny discount, say 2%, if they pay within 10 days. At the same time, call your own suppliers. See if you can get a little more time to pay your bills. Even an extra 15 days helps. And of course, look at your sales from last year, so you're not tying up a bunch of cash in inventory that's just going to sit there.
And it's not just about payments in and out. Think about your big overhead costs. Instead of carrying full-time staff through the winter, could you hire contractors for that summer rush? Or hey, could you sublet your shop during the off-season to another business whose busy time is your slow time? It's about getting creative to make your business more nimble. Okay, so once you've got your day-to-day cash flow dialed in, it's time to think bigger. Let's talk about the gear that's going to help you grow. That brand new excavator, a better boat for your tourism business, an upgraded commercial kitchen. This is where smart financing is an absolute game changer.
You really have two main paths here, leasing or getting a loan. With a loan, that equipment is yours from day one, which is great. But you'll probably need a down payment, and you might even have to pledge other assets as collateral. With a lease, on the other hand, you usually don't need a down payment, and it's way easier to upgrade to a newer model when your term is up. It really just comes down to what's best for your business and your cash situation right now.
But listen up, because this right here, this is the secret weapon for seasonal businesses. It's called flexible payments. A lot of lenders, especially with leases, will let you make bigger payments when you're slammed with work, and then smaller payments or even skip a month or two when things are quiet. This is huge. You should always ask about this. It perfectly aligns your biggest expenses with your biggest revenues.
All right, so you're ready. You know you need financing. You even know what to ask for. The big question is, where do you actually go? Let's quickly look at the different kinds of lenders out there.
Now, before you start making calls, it's really helpful to know what they're going to be looking for. Lenders want to see a solid track record, not just one amazing summer, but a few good years in a row. They'll want to see that you've got some cash reserves, a good credit score, and a really clear plan for how you're going to use their money to make more money. So get your ducks in a row, and then we'll figure out where to go.
You know, I love this quote I saw from a business owner on Reddit. It just hits the nail on the head. Sometimes, yeah, you have to spend money to make money. And the cost of not having the right equipment, all those jobs you can't take, the customers you have to turn away, that cost can be way, way higher than the interest on a loan.
So who do you talk to? Well, the big banks will have the best rates, but man, they can be slow and pretty rigid. Then you've got alternative lenders. They're faster, they're way more flexible, but you'll pay for it with higher rates. Brokers are awesome because they do the shopping for you. And hey, don't forget to ask the person selling you the equipment if they offer financing. Sometimes that's the easiest path of all.
Oh, and one more pro tip, don't sleep on government programs. There is a lot of support out there for small businesses, especially in key industries like agriculture. You might be really surprised what you qualify for. A little bit of research here can save you a ton of money.
So, after all that, what's the bottom line? It's not about trying to fight the seasons. It's about building a business that's strong enough and flexible enough to work with them. It's about building a business that can weather any storm and come out stronger on the other side.
So here it is, your 5-step plan for year-round success. 1. Know your numbers, especially that DSCR. 2. Master your cash flow. 3. Finance your equipment wisely. 4. Find the right lending partner for you. And 5, and this is the big one, always insist on payments that match your seasons. You can do this.
So I'll just leave you with this one question. Are you just trying to survive the off-season, or are you ready to start planning to thrive in it? Because with the right financial plan, you can turn that quiet time into your secret weapon. You can use it to rest, to plan, and to get ready for your best year yet. It's time to stop just getting by and start getting ahead.